Hi, my name's Mark Ashworth.
I'm Neil Harding.
Welcome back to Property Insight. Today we're going to be talking about why so many people recommend that people buy investment property in a limited company. There's a lot of talk in the property world about buying stuff in a limited company. It's a question that both you and I get asked so often. So what is the deal? What's the hang up with this? Do we buy it like this or do we buy it like that?
Yeah, no, you're absolutely right. And for me, I actually own some properties in my own name, myself and my wife. And we also own property within our limited company as well. And it's really a bit of a horses for courses thing. Many of us will have heard the recommendation, speak to a property tax accountant. And I suppose we do have to say that is absolutely what you should be doing. Always speak to a property tax accountant. Everyone's situation is difficult, but it can also be a bit frustrating to always hear the answer, go and speak to your property tax accountant, without anyone actually saying, yeah, that's all very nice, but I just need to actually know some information about what helps me decide. So one of the things that is important is tax. And one of the reasons why people are buying in a limited company is because of tax. And also, therefore, unfortunately, sometimes people are buying a property in a limited company and it's not actually the most tax efficient thing for them to be doing. You might have heard of Section 24, or also known as the George Osborne tax, that was introduced and phased in over a period of a few years, and it's been, this is 2023 now, and it's well and truly fully implemented. And basically what that means is that the mortgage interest the cost that you incur on mortgage interest cannot be deducted for tax against your rental income for properties that you own in your own name. Instead, what you are allowed to have is you calculate your net income after your other costs, and then the tax man will give you a 20% tax credit against your tax bill. So calculate your tax and then look at the interest that you've paid against your mortgages, and then take 20% of that number and deduct it against what you owe the tax man.
So the interesting thing here is I hear you say 20% tax credit.
Yep.
So does that mean then that you can actually claim the mortgage interest off of your tax bill if you are buying in a personal name?
Right. So there's a few things. So I say 20% because it's the basic rate of tax at this point in time. That's one thing I should just clarify. So should the basic rate of income tax change, then my expectation would be that so does that tax credit.
Sure.
Similarly, if you therefore fall into the higher rate of tax, let's say you're a 40% taxpayer or even a 45% taxpayer for that matter, but if you're a higher rate taxpayer, then you are losing out by the difference between the basic rate and high rate. So at the moment it's 20% versus 40%, so there's a 20% difference there. So you are basically unable to offset 20% of your cost. You're really in a dreadful position really, and actually it's that reason why a lot of people are buying in a limited company, because within a limited company you can take all of your mortgage interest cost and deduct it against your rental income and get the tax benefit of that, and that's why people are doing it.
So it sounds to me like the answer here is it depends on your position. So let's say you are already in a job, or you may own a company of trading business or something like that where you're earning a level of income. So depending on your tax position there for that particular purpose is going to then directly impact the amount of tax you pay on your portfolio. So that's the point where you need to decide whether or not you should be buying in a limited company or whether you should buy on your in your own name. And if your intention is to perhaps give up a job to perhaps you're going to invest in property where you're not going to have that job anymore, then that might be a consideration for buying in your own name initially. Whereas if you intend to keep that profession, you intend to keep earning money in that particular career, or you've got your husband and wife or your partner, civil partnership team where you're going to be investing together, you need to look at your overall income to then essentially decide how you want to purchase. So we've done a video already on goals, right? So like, how do you want to invest? What's the purpose? What are you trying to achieve? Going back to that going back to the drawing board, let's say, to try and work out what it is that you want to achieve will then help you to make those decisions. And perhaps, as you say, having some of the portfolio in your own name and then having some of the portfolio as a limited company is potentially quite a good option. You could certainly do a little bit of both, but again, depending on whether you want to keep that earned income profession, whatever that may look like, PAYE or...
That's right, absolutely. So it's not necessarily the case that you have to buy all your property in your own name or all of your property in a limited company. Yeah. A bit of a hybrid may well suit you, especially within maybe a husband and wife team. Some properties, maybe if you've got one of the couple who doesn't have any other income, you could earn up to sort of £50,000 of rental income or net rental profit before, excluding the mortgage interest, before really Section 24 and it becomes a problem, and then start buying in a limited company. Or as you say, if you are both professional workers earning good money, and actually what you're trying to do is retirement plan, then a limited company might have been, regardless of Section 24, might have been the best bet for you anyway, because what you're then able to do is store up, effectively accumulate that wealth within a limited company, separate legal entity to you, and then 10, 20, 30 years even later, when it comes to your retirement age, you can then take that wealth out of the limited company at a time that suits you and pay income tax at a really low rate when you've got no other source of income. So there's lots of other things to consider with tax planning.
I think what's difficult when people ask questions around how to buy things, and particularly when it comes down to tax, is that for everybody's situation is different. So, and also everybody's intentions are different. So, there are many people that think that property investors, are earning lots and lots of money in very well paid jobs, but actually that's not always the case. You may have inherited some money that you want to invest in property, and you may be earning, you may be just a 20% taxpayer, so you may be earning £30,000-40,000 a year, maybe 80,000 between you, maybe not even that. I mean, it doesn't really matter. But if you've come into some money and you're thinking, okay, well, I'd quite like to invest that in property, it's important to try to understand the UK tax laws, the UK tax brackets, and then also try and understand how much you're intending to receive and earn from these investments for you to then make an informed choice, which is generally why you get the answer, speak to a property tax accountant. But hopefully that little bit of insight there will give you a bit of a helping hand as to how you may go about deciding which way to go.
Yeah, and also help you know what questions to be putting to your property tax accountant as well. To have that conversation. Yeah, and there are other, have a conversation with the property tax accountant is important, and there are other taxes to think about as well. So you might want to be talking to them about inheritance tax, capital gains tax. How do all those other taxes impact you?
Yeah, I would also say that whoever you talk to and whoever advises you, or not necessarily advises you, but whoever gives you their opinion, obviously this is not financial advice. We're not giving any financial advice. We're just trying to provide a summary of what you should consider. But if you do talk to people about your tax position, unless they know the whole of your tax position inside out, then there is no possible way that they could advise you. So don't go on people's opinions to make decisions. It's really important that it's proper advice based on your situation.
Yeah, completely agree.
So we hope that you found that insightful, and please comment or send us a message in some way if you want to ask us to talk about any other factors that you're struggling in with property investments. We'd love to hear from you. But until then, we'll see you on the next one.
Goodbye.